Thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the everything other than tech rally. And what that says about the state of stocks in this early year. We will ask the investment committee. And joining me today for the hour, Josh Brown, Jenny Harrington, Bill Baruch, Sarat Sethi. Let's check the markets. We have had a nice turn in the market today. Certainly the Dow, the S&P, they are both positive. NASDAQ, though, playing to the theme that we're talking about today, is in the red. The Russell is leading the way once again. As we said, the early year story has been the performance of things other than the mega caps and the NASDAQ. Financials, industrials, and as we said, the small caps. The Russell hitting a new all-time high this morning. It's up almost 4% to start this year. And we find it interesting today that Bill Baruch is trimming his position in it. Why?
Well, we own the IJR. It's a more concentrated small cap ETF than say the Russell 2000. And we actually doubled our exposure in that in Q4. We went from a 2% holding to more than a 4% holding. We looked for some follow through. Now, the IWM really accelerated and outperformed the IJR. Although over the last 5 years or so, the IJR outperformed the IWM more significantly. And I'm a little disappointed that we're not getting that move. Now, what we're looking at here is we trimmed it down, more of a rebalancing, bringing that back closer to a 4.25% from nearly 5. And what it's doing is raising a little cash for us because remember, there is going to be some news tomorrow. There is going to be with jobs and Supreme Court rulings. But as you look in the year, I think really the important thing is this is going to be the first quarter. You need to make your money in the first quarter. I think the year could really level out from April to November. And there's a little bit of a seasonal lull in the middle of January. So what we're doing is we're raising a little cash and some rebalancing, taking a little bit off the table here in small caps, seeing if that actually gets the breakout, maybe lean into it more.
Isn't it already getting the breakout? I mean, the follow through that you were allegedly looking for at the end of the year into the new one is happening, is it not? And
not in IJR. Well, IJR has not made a new record high yet, so I'm ill positioned. So I want to look at where I can put that cash. If I raise about 60 basis points or so,
I mean, IJR is up 4% year to date.
Yes,
like 4 days.
And we've picked up from that ad in Q4. We picked up 4 to 5%, and so that's what we're taking a little off the table, a little rebalancing. But it gives us that flexibility, and you want to have flexibility. If you're sitting there fully invested and you get a little bit of a knockdown or the market moves a bit, you can't be active. You can't do anything else. So what we're looking at here is we're trying to find some places, rebalance, raise a little bit of cash, and if we get that breakout in IJR, maybe I'll lean back into that. But I think there's better places. IWM is more clean right now of a breakout. You're getting more materials. You're getting those biotechs that are driving it as well, where IJR doesn't have that. IJR has a little better balance sheet than IWM.
What do you make of the complexion of this market so far this year?
Oh, I love it so much, to be honest. It's nice to finally have stocks that are in favor. I really have been enjoying the rotation that I've been seeing and seeing it broaden out a little bit, and it makes sense to me. And my thoughts were last year that the winners of the last couple of years should take a pause. I don't think their valuations in general were so rich that they deserve to have a major decline, but I think that they deserve to have a consolidation. And I looked at the last couple of years as all the money just got soaked up into a small portion of stocks. And there's other companies out there, like the ones in our disciplined growth strategy, like the ones in our equity income strategy, that just sat fallow. Meanwhile, they had really compelling valuations, like perfectly great earnings growth. So I like it. It just seems like reasonability is coming into the market. Rick Reeder put a piece out yesterday, and I thought the headline was really interesting. He said, odds are changing. 2026 is a market for investors, not gamblers. And I read the article, and what he's really fleshing out in there is that you have to do the work this year. You have to think about valuations. You can't just jump on the winning trade. So it seems like it's working. But one thing on the small cap that I just think is interesting, and this is something I was struggling with as I was writing our quarterly letter yesterday. I was saying, but small cap, the Russell 2000 was up 12%. But the other one, right, the S&P 500 is up 6%. So as Bill's fleshing that out, I think even going into this year and seeing differences in two indexes that superficially sound the same.
Banks versus biotechs. The small cap 600, you have to be profitable to be in the index. As a result, it's a higher concentration of some of those older industrials with profits and obviously financials. The Russell 2000 is a junkier index. It's got a lot more of the non-profitable biotech, a lot more of the non-profitable tech, some of the more startup-y type companies. It's really just a reflection of whether or not you're in a high risk appetite or a lower risk appetite market, which one will outperform the other over very long stretches of time. They end up meeting up.
And it feeds in exactly to the Rick Reader comment, which is, again, to me saying basically, you've got to do your homework. You can't just say, hey, small cap was up 12%.
You should, right. If you're investing in small cap, you should know the difference between those two indices.
But if you're investing in period, you can't just say, I want to own small cap and choose any old index. You have to do the work and know that there's a difference.
What are we in now? Are we in a higher risk or a lower risk market?
Okay, I love Alpha Jenny. I am here for it. Like this, the season of Alpha Jenny is upon us. But I really want to make this clear to people because I don't think they understand. Just because all of the focus and the attention has been on the AI build out and the data center story for the last year doesn't mean that what's going on right now is anything new. In fact, the peak of the Mag 7 versus S&P 493 outperformance was over a year ago. That outperformance peaked in December of 2024. 25 was a very mixed year for the Mag 7, and as a group, they did not materially do better than the S&P 500, and now you see that following through this year. Super bullish for stocks. Just looking at an interesting data point that we've been looking at, every single sector positive except tech today. We've only had 10 other days since 1990 where every other sector was positive and tech was down. Tech was down almost 2% on the day at its low. There's no news. There's no earnings. The only thing driving this is people looking at their portfolio and saying, wow, you know what? There really are other games in town. Financials, industrials, there are other things I could be doing. The other thing I would point out here, and I think this is really important, if you actually look at this as a horse race in terms of like, do I have a barbell in my portfolio? Yes, I love Apple, I love Microsoft, blah, 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 but do I have enough on the other side of the barbell? Most investors would have to conclude, no, I actually don't. And I think that that is what's driving the rally, not just today, but this is a rally that's been building since September, October in these quote-unquote other stocks.
You continue, Sarat, to get a number of outlooks for 2026. Some are looking at seasonal analogs from past performance periods to look for what happens now, including Goldman's Tony Pasquarello, who suggests over the last 75 years, if you look at that, it's not a guarantee of anything. However, as he says, they seem to point you in the right direction. There's a look at seasonality for the last 75 years, as he says. Quote, but I do think they point you in the right direction. If you want to send me your brother-in-law's tweet, why this won't work in a midterm election year, fine, I'll read it. But, if you use history as your guide, you're probably heading into a pretty good place. You also have those who, though they're bullish, suggest that it's not going to be a linear year, that it's not going to be that straight line, Tom Lee included, who suggests there could be a mid-year bear market before you have another turnaround. What do you think?
Absolutely. I mean, investing is never linear. We saw what happened last year in April. And I think the key here is when we talk about broadening it, we think of it as quality, right? What are the quality companies that you could have owned over the last 3 to 5 years that didn't do anything? Whether it's in healthcare, industrials, financials, and I think that's where quality comes up to where earnings are going to be important and valuation is going to be important. So, if I'm buying the healthcare sector, what am I buying there? I want to own J&J in there. I want to own Thermo Fisher in there. If I'm buying financials, I want to own Morgan Stanley. I don't want to own PayPal at this point. I want to own Visa, MasterCard. So for us, it's the quality play. Yes, and Josh is right. You can barbell with our techs, but where's the other alpha going to come from? And I think that's going to be important.
You're hitting on a really good and interesting point of what we've been hearing the last few days from people on the desk, that it's going to be a much more tactical kind of year than buy, the S&P and just look at it at the end of the year and you're up 15 to 20, if not 25%, like it's been for 2 out of the last, 3 years. You have to be much more tactical, and you are pointing in that direction as well.
100%. And I want to be in the areas where it's not just multiple expansion, it's earnings growth and it's company being recognized as we go through this period of a little more uncertainty globally, and really what are companies going to do specifically as if they're going to be in margins, AI, tariffs. That's all going to be really important.
Well, it comes down to earnings, right? I mean, earnings have
100%,
earnings have to deliver. Expectations are high. Yeah. Some suggest maybe too much so. But it certainly is a good debate as to where we are. Wells Fargo today pointing out that the outlook, it has to hold. It has to, because you've exhausted all of the multiple expansion that you can get. maybe to this point, 22 times. Now you got to deliver really from an earnings standpoint.
Yeah, so two things here that I think are really important to understand. We had multiple contraction last year for mega cap, large cap stocks. We had unbelievable earnings growth, far exceeded anything anyone thought was possible, especially around the spring. We were worried about tariffs. And large caps, by and large, delivered and did not get multiple expansion as a result of that, but we still were able to have a pretty good year. Overseas, it was the opposite. Overseas, they barely had earnings growth, but what they did have was a huge sentiment shift. And as a result, massive multiple expansion. Japan, Germany, France, the UK, some very big markets overseas, got a lot of that PE re-rate higher. This year, I think the thing is, can the mid caps and the small caps and the non-mega cap large caps deliver the earnings that make them worthy of a re-rating and maybe take some of the leadership burden off of the top 7 stocks? Michael Sembelis refers to this as the internal logic of the stock market. We're not just willy-nilly putting a 22 multiple on the S&P 500 for no reason. Those companies have the best earnings growth and the biggest profit margins. Matter of fact, we were talking about small caps before. They sell at 15 times forward earnings. Why? The S&P 600 has a 5.6% trailing 12-month profit margin. For mid caps, it's 7.5%, and for large caps, it's almost 14%. That's a really big difference, and that's why those segments of the market have been sleepy, because they haven't earned it yet. Can they earn it? Can AI help these companies expand margins? If that happens, not only do I think you get the benefit of that earnings growth, I think you also get a multiple expansion and a little bit of a re-rating, not to 22, but there's a lot of room between 15 and 22.
Let's talk about one of, I think, the best. If you want to call it a comeback story, by all means, go ahead and do that. Or a we'll show you story, what's really going on. It's Alphabet. Look at the last 12 months of Alphabet. You'll see what I'm talking about. Today, it surpasses Apple in market cap, okay, for the first time since 2019. That's a statement in and of itself, where people were talking about this stock in such negative ways 8 to 10 months ago, and it has defied all of those negative expectations. It's about $4 trillion, knocking on the door of that, so it surpasses Apple. Serata gets upgraded today to overweight at Cantor. They cite the golden age of Gemini. The newest version of Gemini has seemingly put this thing right back in the driver's seat, according to some accounts.
Yeah, and we were sitting here months ago, and it was search is dead, Google's dead, Alphabet is, gone. What do you have left? YouTube, well, that is growing. Yeah, but you look at what's going on in the media space. But I do think they've come to the table, and they've come back really strong, and they're leading. And I think it's going to be lockstep, 1, 2, ChatGPT, whatever, but they're there. And their earnings are there, their cash flow are there, and they're growing. And I think that's why people like them as the leader at this point. But I would be careful. I mean, it's our largest holding. I like it, but if it gets too big, we're going to trim it back, because you just never want to get too greedy with stocks like this, because we've seen what happens when something else comes in.
Bill?
Yeah, it is our largest holding. It's 7%. And I got roasted on, I think, by you two here, or when I added to it in May of last year. I think Jenny was giving me a lot. You're giving me a lot of heat. But this is
I was selling it. You were buying it.
This was our thesis. Was a call option on the TPU, and it was the idea that maybe, just maybe, that AI could be a tailwind instead of a headwind, and that's what we're seeing play out. Now, I do agree with you. It's become a 7% position for us, and at some point, the valuation that it is seeing right here could be a little headwind to continued growth. So as everybody's talking about being a stock picking market, where's the puck going to go next?
Yeah, so Alphabet was being very cautious about AI a year ago at this time, at a time where they could not afford to be. They had to decide, you know what, we're going all in. We're not worried about cannibalizing search ad units. We're putting the ad units right into the AI Gemini responses, right at the top of search, and we'll let it play out. We'll see what happens. It was the right decision. It was very bold when they made it. They were a little bit late to making it, but it doesn't matter. The stock went up 65% last year, one of the biggest winners, not just of large caps, but in the overall S&P 500. But now, you've gotten a lot of the credit for that. So I agree with you. It's not an all clear just because the bet paid off. because it's not exactly one of the cheaper Mag 7s the way it used to be.
Jenny was giving you the business because she's like, hey, look at my Meta. My Meta is the one that's going to do much better than Alphabet. And that was at that point where, you had a lot of talk about Llama, open source.
Yeah.
They're putting all this money behind it. Surely they're going to outpace people like Alphabet, and you know what? It just hasn't happened. In fact, the stocks have gone in opposite directions.
I think what I still, like, if we're being serious about this, I think what I still worry about with respect to Alphabet versus Meta is the monetization. And so even though Gemini has been really quite amazing and stepped up there, I really do still worry about the profitability of search in the future with AI, with the way AI works.
Haven't they proven that those concerns are not well-founded anymore?
No, it's way too early. I think we're way too early for anything regarding AI to be proven out yet. We just don't know how it's going to play out. But I know.
Well, then why do you have so much conviction behind your Meta?
Meta makes their money differently, right? Like every time I go on Facebook or Instagram, they're popping something in front of my face that I actually pathetically find incredibly compelling to buy, and that's just a different ad mechanism than when I search. And I think my search year over year on Google versus Claude and Grok and ChatGPT, I think my Google search personally is down by probably 95%, even with Gemini. And so they're just not getting those ad dollars. And I think we're so early innings on this that I don't know how it plays out. So my concern is just like that we don't know. But I want to.
Well, I mean, the stock. Hold on, before you move on, I don't want to get off this point. The stock performance seemingly has voted in terms of how the market sees all this playing out.
So here's what I think.
Meta's
up
5%. In the last 12 months.
Here's the problem with 2025. 2025, for the most part, was a year where the story of a stock drove the share price more than the valuation, more than the revenues, more than the earnings. So if you could tell a good story about how AI was going to benefit, the stock price went up. And so then we saw towards the end of the year, we saw some reconciliation of that start to step in. Like, look at what happened with CoreWeave, right? CoreWeave got up to $170 a share or something, and then once that dialogue started to change during the year from tell me a story about how AI is going to be amazing to show me the dollars for it, things started to fade. So you saw that fade in Oracle after the bloom came off the rose, with the $40 billion, whatever it was. You saw it start to change in CoreWeave. I think Alphabet still has more story tailwind pushing the shares up because they can prove it out more than their smaller, less proven peers. But it's going to take them some time for the numbers to actually come about. I still like Meta the best because when I look at it, to me, there's still the most assured earnings growth ahead, and it still has a reasonable.
The worst AI story of the group.
Who knows it?
But here's the thing. As Brad Gerstner was saying when he was on the other day, who no longer owns it, by the way.
But here's the whole point. Josh says the worst AI
right now.
But he says story. Change. He doesn't say the worst AI revenue.
Oh, Jenny, they're monetizing Reels. They're monetizing Reels like there's no tomorrow. We agree. It's not a fundamental problem. Investors do not believe that the avenue that they're not substitute story with strategy. Investors don't believe the idea of Meta doing the spend that it's doing is going to have the same ROI payback that Alphabet obviously already is starting to see.
And they don't believe it. It's just too early. So you need like a year and a half, or 2 years of the actual revenues, of the actual earnings to start to show up before we can say who's going to be the winner.
Where my concern lies is we're actually seeing search get more normalized. Traffic is down 20-some% over the last few weeks on ChatGPT, but you're not really seeing it bump up in traffic onto Gemini or elsewhere. So I think that's where one of my concerns lies in what we see kind of develop over the next few weeks. But I also think there's too much negativity around Meta. There was a lot of support around $600, but it's going to have a very difficult time getting above that pre-earnings level, which was maybe 740 or so. So I think right here, this is why you're seeing these other sectors start to benefit. The puck is going elsewhere, and that's really what we're seeing.
They're launching a lot of things though that they're not getting traction on, and you can't say that about Alphabet. What Alphabet has done successfully with Gemini is they've integrated it into all of their verticals, from Gmail to regular Google search to Docs, Drive. Meta just can't point to that. We know that they are one of the preeminent users of AI to drive profitability in their ad unit business. We understand that. But we're not seeing all these things they're launching get the same traction that we're seeing at Alphabet.
But Bill's making a really important point that we've been kind of started the show on. These are good stocks if you want to own them, but there's other stuff to do also. And we can argue day and night as to what is Meta going to do? Is Zuckerberg going to spend another $1 trillion to do this, et cetera? But if we are seeing clarity in other sectors, that's what we want to talk about. What is the opportunity other than the big seven?
I want to pivot away from this because we're running light on time for our A block today, and I want to get your reaction, Josh, to that story yesterday. These social media posts, President Trump trying to ban large institutional investors from buying more single-family homes. I know it's a hard right turn from where we were, but nonetheless, your Invitation Homes was down a lot.
Yep.
Blackstone was down a lot. There was stuff related to defense, too, that we can get into later on. But what's your reaction to this move in Invitation? Today's a bit of a meager bounce back relative to the pullback yesterday.
Yeah, so the stock's been basically listless for over a year. I think it's just not been a great environment for the rental home business relative to a lot of other areas that people could be invested in. So it's definitely in the bottom portion of my own holdings. That being said, we have to differentiate between tweets and policy, and we have to understand that for political reasons, there have always been people raising issues with institutional ownership of single-family homes for very obvious reasons. We have a lot of housing markets in this country where there's just not enough supply. Prices are absurd. They don't make sense relative to incomes. They don't make sense relative to the availability of mortgages. And any time that becomes a political issue in the headlines, we absolutely see a reaction in any of the institutions that have a publicly traded vehicle that are involved in this part of the market. But it's not legislation. So as an investor, doesn't mean that you just turn a blind eye and say, forget it, it'll blow over. I think you do have to pay attention to a very real possibility of things changing here. They haven't changed yet.
Yeah.
Blackstone responding to this post, saying our ownership of single-family homes is about 2% of our real estate AUM and 0.5% of the overall firm. We've also been a net seller of homes over the last decade, with our holdings down more than 1/5. That said, we believe our current portfolio is poised to continue to perform quite well and operate at the highest standards for residents. That's sort of Blackstone sticking up for itself. That stock was hit especially hard yesterday. It, too, is getting a bit of a bounce. So let's do this. Let's take a quick break. Let's talk about some more moves that we have today from the investment committee. We're staying in the metal space, okay? Bill, we'll go to you. You trimmed the GDX ETF and also gold and silver, the CEF.
Yeah.
What's up?
Yeah, so just we talked about just trimming in a rebalancing area. So gold and silver and the miners have had a tremendous run. I'm not negative on them necessarily, but I think there is some froth that is building. I think everybody could agree with me. You see silver headlines almost every day if you're looking for it. The thing here about miners specifically, the cash flow is going to be terrific. The cash flow is going to continue to increase and be an amazing driver of margins going forward. But I think at this point, if you're not locking and monetizing some of the move that you saw last year, you're probably doing it wrong. And what you're also seeing is you're seeing from exchanges, the CME group, as well as the Shanghai exchange, they're raising margins on silver. So I think, and then you're also seeing the commodity fund rebalancing. So I think we could be over the next 1 to 2 to 3 weeks, we could be a little more of a consolidation phase. And again, I'd like to rebalance some of that cash and be able to be on offense as we look into the back half of January.
Let's be clear, too, for the purposes of this conversation, that all metals are not necessarily created equal. When you talk about what is perceived froth, if you want to look at gold and silver versus some of the industrial metals like copper, for example, where there's a report today that Reuters was citing that AI to boost copper demand 50% by 2040. More mines are needed to ensure supply, they suggest, but nonetheless, that's a big number that would play to what exactly I'm talking about.
If you look at the a chart of supply deficits in copper out through 2030, 35, it goes like this. The deficit continues to increase every single year going further out. And we do like copper. The thing here is copper's also against the July highs on U.S. priced copper. And we're starting to see with tariff fears a little bit more of spread between the U.S. price of copper and the LME price of copper. So that's also where that froth sort of builds in. I actually bought on my commodity fund, did buy copper futures this this morning. I think there's a lot of support around 570. So I'm looking at that to kind of be a sticky area. But if you look at it, I still like the metals in general. What we're doing is rebalancing the big move in gold and silver. And I have a bunch of things on my radar that I'm looking at buying. Look at the basic materials ETF. It's breaking out right now. There's a lot of places kind of within materials that you can maybe look at as well.
Okay, so Jenny, you own Freeport, you own Rio Tinto, but you're selling Anglo American, which happened late in December as the year was coming to an end. We haven't seen you since, so tell us more.
So this was just working out of a position in our international income strategy. It's portfolio management. It is not a comment on metals. So Anglo we've owned since 2018. We have about 130% return on it. We've collected a ton in dividends, but they cut their dividend and the yield is now below 1%. That no longer fits for us. So in addition to that, we were disappointed in the BHP takeover attempt that failed. The restructuring's been slow. There's strategic uncertainty around the Tech Resources merger and no yield. So we're like, you know what? This doesn't fit this strategy
But then
anymore.
what you're saying, though, is that your positive view of the space is better represented by your continued ownership in Freeport and Rio.
Exactly. And Rio is interesting, too, because you've got some aluminum and some copper there. So to your point, you're not making a huge bet on any one metal. You're saying, hey, I like this space comprehensively.
All right, we are back. I said we're going to highlight a couple of stocks today in the best stocks in the market, according to Josh Brown. Your spotlight's on energy. You've been focused here for a little bit, and rightfully so, given what we've seen of late from some names.
So what's cool about being focused in this energy area of the best stocks in the market is there haven't really been that many of these stocks. Like they're kind of a very small part of the list relative to the obvious areas like financials and technology, where I could show you a different name almost every day. That being said, the list obviously has expanded this week. Obviously, we came in Monday. We had huge gaps higher in a lot of the biggest stocks in the energy patch. And I wanted to update the audience on some of these because we've been covering these bullishly throughout the course of this year. Valero, which is my favorite name of the refiners, stock looks great, had a big gap up. It's digesting that gap, but really not giving much back here. This could be a gap and go. This is a breakout to a new high. And it's an obvious beneficiary whenever people are looking to buy more energy, get more energy exposure to their portfolio. This is more a play on gasoline demand, though, than it is on raw oil price.
Can I ask
It's
you
really
a
important.
question regarding this?
Yeah.
Because this name has been so much impacted recently by news events.
Yep.
Is there any risk in the
100%.
fact that the way, as you pointed out in the beginning, a tweet here, a tweet there, an action here, an action there, a pullback here, et cetera, and then this stock doesn't look like it does because it was so recently news driven?
100%. So I actually had this conversation with John Malloy at CNBC Pro, and the obvious thing, I guess the journalistic mindset would be, let's write about energy stocks on Monday morning, right? And I said, no!
Wow.
We are going to allow these gaps. We are going to allow these gaps a couple of days to see how quickly they fade. And that was the mature decision, and John agreed with me. And look at Chevron. He gave all the money back. If you walked in Monday morning like a Muppet, bought Chevron, you gave it all back. So the idea is, let's give it a couple of days because, Judge, you raised the right point. The other two names, just quickly before I get the hook around my neck. Baker Hughes, we have to talk about Baker Hughes. This is one of the better acting stocks in the energy sector all year. It's energy services. It benefits from increased activity. Obviously, Halliburton, Schlumberger, they're all hitting the list right now. These names should be on investors' radar. And there are a lot of other names here that we can get into, but I think those are a good focus because they're all on the verge of major breakouts, or like Valero, they've broken out already.
You own Chevron. You want to just comment on this area?
Yeah, I own Chevron, I own Exxon, I own Schlumberger.
I'm in Exxon personally.
I like these stocks for reasons that we just happened this week because they're diversified in your portfolio. And even if oil goes to 50, 55, you get global geopolitical uncertainty and you want to own these stocks. High dividends, great cash flow, and they provide that base in your portfolio.
So the thing is here, the U.S. refiners can't really process this Venezuela grade. So you have this big spike up, the froth is coming out. But the names like Schlumberger or SLB, I really do like. I think you're seeing a very nice technical bottom. I think the infrastructure idea within the space is very bullish.
All right, we're back right after this. What's your take on this stock?
Look, I think the market with autonomous grows. It's like when a coffee shop opens next to a Starbucks. Everybody, it's going to be demand.
Back this out, guys, if you would,
so
please.
I do
like
think
6 months, maybe. Thanks.
There is demand. I like it. And Jenny, we've owned it since in the 20s as well, because it was a value stock back there when nobody else wanted it. But I'm also kind of going to look at it when it breaks through 100, because it's no longer a value stock. It is a fully value stock that has growth attached to it. And that always concerns me, because it's cyclical as well, because the economy will then focus on where the stock is going to go.
Yeah. A free cash flow story gets back above 90 bucks. I think you're going to see some really strong tailwinds and flows.
In what sense? Like, what are the tailwinds? Why would flows start coming back in the name? Just because it gets...
I mean, very, very good technical setup. A lot of indicators will start turning up, and I think you start seeing the flows, because it may have corrected. It was still a really great year last year, and so on that sense, you're going to start to see a lot of the algos, a lot of flows start to pick into that.
Yep.
Number one, it's not a technology stock. It's in the transportation sector. If you're a manager and you're filling slots in your bucket, what transportation stocks do you want to own that have the highest growth versus the lowest valuation? This is like number 1, 2, and 3 on your list. It's the most obvious thing in the world. Number 2, nothing would be better for Uber than an autonomous future where a quarter to a third to half the rides on their platform are being driven by NVIDIA-powered machines. Doesn't matter who owns them. Private equity could own them. Mercedes-Benz, Toyota, Volvo, Tesla, Waymo. It doesn't matter. What matters is Uber's take rate goes up because there's not a human driver necessarily doing every single ride. This is the most obvious thing in the world to me. They are the demand aggregator. People like to say, oh, there's no switching cost. I'll just download the Waymo. Okay, well, you could have just downloaded the Lyft app all this time, and you didn't.
It's like catnip.
It's 185 million global users already on the platform, and their biggest cost is about to literally go away.
All right.
I don't even know what we're talking about.
Can't resist talking about it.
Sorry.
Let me just tell you what's coming up at 3 o'clock. We've got Adam Parker, Chris Harvey, Doug Clinton, Torsten Slok, but also Walter Isaacson is going to join us. He's going to talk about the future of capitalism in the wake of some of what you've heard out of Washington, D.C., whether we need to rethink about what the future of that looks like. He will help us understand that, and I hope you'll join us for that conversation. Final trade, Sarat, what you got?
Morgan Stanley, I think you got great tailwinds in the wealth management business.
All right, Bill Baruch.
Leidos, the chart is almost as beautiful as the balance sheet. Look out above 200.
Which is why you bought more?
I bought more of it.
Okay, Jenny?
Okay, enterprise products. If you like energy but don't want commodity price exposure, enterprise is where it's at, 6.9% yield.
JB?
Amazon bucking the tech trend, going higher. Stock looks great.
All right, I'll see you at 3.
Hello, everybody. Welcome to Blue Cloud Trading. I'm George. It is Friday, January 9th. It's actually 11:37 a.m. Eastern Time. It's a little later here where I am. As you know, some of you know, I'm in Tenerife, which is a small island in the Canary Islands of Spain, which is west of Morocco. And the climate here is pretty much like 68 degrees every day and sunny, 68 to 70. Perfect weather. Perfect weather to be outside. Anyway, here's what we're going to do. We're going to take a look at the following stocks that they talked about on the halftime report. That was Josh Brown and other guests. And let me show you the list of stocks in a few moments here. We got it's about, are you ready for this? 18 stocks that we're going to look at. I've already reviewed all these, and I've got the ones highlighted with a blue flag that are the strongest stocks and ETFs. And we're going to show you guys, I'm going to show you guys the technicals on those in a few seconds. We're going to look at the SPY, the Qs, the Dow, the Russell 2000. We're also going to look at some of the Mag 7s like Tesla, Apple, Meta, Microsoft, Amazon. And we also have these 4 stocks that we're going to look at here from our members. So let's first take a look and see how the market's doing right now as we speak. And you can see the Dow is up currently 0.43%. Nice. NASDAQ is up 0.63. S&P 500 is up 0.49. Russell 2000 is up the most, up 1.04%. So let's take a look at some of the highlights of what's happening right now. You can see that December payrolls rose by just 50,000, marking the weakest annual job growth since 2003, outside recessions. Unemployment rate eased, though, to 4.4%, reinforcing expectations for a Fed rate cut or pause in January. Tech and small cap stocks are outperforming with strong risk appetite in semiconductors and nuclear AI-linked energy names. Traders monitored a delayed Supreme Court decision on Trump-era tariffs for potential market impact. limited earnings news provided little additional direction for the session. So, all right, well, let's look at the heat map also. One of the things we like to do is take a look at the S&P 500 stocks, and there's the list right there of ticker symbols, and the ones with the little green, if they're highlighted with a really bright green color, that means that they're up over 3%. If it's very bright red, it's minus 3% or somewhere between 2% and -3. Google, Meta, Tesla are all up. So is Nvidia slightly. You've got Broadcom and most of the semiconductors, except for QCOM, which is down 2.01%. The financials like JP Morgan, Bank of America, Wells Fargo, Citigroup, they're all up. The energy stocks are doing pretty well today. Exxon and CVX there, ticker symbol CVX. Yeah, healthcare stocks are slightly down. Netflix is down 1.98%. Let's look at the groups to get a better picture here. So this is the one-day performance. You'll see that utilities, basic materials, industrials performed the best. They were all up over 1%. There was only one laggard here for today, down 0.03% is healthcare. Again, the market hasn't closed yet, so we still have a little time. For the 1 week performance, basic materials, consumer cyclical, industrials, and healthcare, and communication services are all up over 2% for the week, and utilities down 0.74%, as you can see. So let's get into the stocks now. We won't spend too much time on these. We don't really need to. That's the beauty of the Ichimoku indicator, which is what we're using here. It's a Japanese indicator incepted in the late 1930s. Okay, think about that for a moment. And it was published in the late 1960s. Okay, then it was brought here to the United States, and they started utilizing it, financial institutions and everything, in the late 80s or so, or mid 80s. And now, I mean, it's still utilized by many financial institutions. So it's a really good way to quickly assess what's happening in the markets. We can quickly see if a specific stock or ETF is in a strong uptrend, which is determined by looking at where the position of price, which is these Japanese candlesticks, are in relation to the moving averages. And there's just 5 moving averages that we need to memorize here. You've got your conversion line, or Tenkan-sen, the green line right there. It takes the midpoint of the last 9 periods. So if you take the high, the low of the candle, divide that by 2, that's the midpoint, right? And basically, imagine it's like just taking the midpoint of the last 9 periods and plotting it, okay? And we want price to be above that. That's important. Secondly, we want price, the second indicator here is moving average is the Kijun-sen, or baseline Kijun-sen. It's the midpoint of last 26 periods. All right, so we get the 9, midpoint of 9, midpoint of 26. So it's a little slower. We always want that green line to be above the red line, the faster one above the slower. Then you'll notice back here, there's another one that's kind of lagging in the background. They call that a lagging line, or the Chiku span. And so what we want that's basically the current price right now. So if I highlight that line form right there, you'll notice it's exactly 26 periods in the past, okay, from where we currently are. And what we want to do is see where that is in relation to the candle. That candle right there, 26 periods ago. If we count all these candles, if the white line is above, that's a bullish, all right? And then the other 2 moving averages are what make up the cloud, the Ichimoku cloud. So basically, you've got the Senkou span A, which is derived by taking the midpoint of these 2 moving averages, projecting it 26 periods into the future. Okay, and then you've got the Senkou span B, the purple line, which is the midpoint of the last 52 periods. Instead of plotting it under the candle, it's plotted 26 periods into the future. Unique. And so what we want is that Senkou span A to be above Senkou span B. All right, that's a bullish cloud. The thicker the cloud and wider the cloud, the stronger the trend. When it thins out like it did over here, it's not as strong a trend, obviously, and it gets negative. And so, it's always projecting the future, so that's a positive. We can see what it's looking like, at least for the time being, and it's looking very strong right now. So the SPY is great on the weekly, and it looks very good still on the daily chart. By the way, I'm also using another indicator called the Directional Movement Index down here. What we're looking for here is essentially the green line, all right, that green line that you see right there. which is the positive DI9. I've got it at a setting of 9. It's called the directional movement index. I want that green line to be above the red line. And ideally, you want that to be moving up, and you want the red line to be moving down, like it is right here. And then there's the ADX, the white line. I've got that at a setting of 9. If that's moving up while the green line is moving up and the red line is moving down, that's a very bullish situation right there. That's what we want to see. I'll just give you an example. Back here, for example, you can see the green line had crossed above the red right there. Once the white line started moving up, if we go straight up, you'll notice it led to a nice move up for at least for a little while. And if the opposite occurs, for example, the red line, like right over here, is above the green line and the ADX is moving up, like it is right there, that tends to lead to a decline in the price, at least for the time being. And then so the white line represents momentum. If that's moving up, momentum is increasing. The second the momentum starts to drop, like it did right there, then basically the shorts come out of the stock and it starts to sometimes move up, which is what happened right there. Okay. So very clear, very easy to quickly assess. Most of my focus is going to be on the Ichimoku, but I sometimes like to use this as a secondary confirmation indicator. And by the way, when I determine whether or not one of these stocks or ETFs is going to get a blue flag, I look at both the weekly time frame and the daily. It needs to pass the test on Ichimoku on both time frames to get that little blue flag that you see right there. So the SPY has that. The QQQ ETF, all right, a lot of the technology stocks are still strong, up 0.77% right now. Here's the daily chart. Here's the weekly chart, still very bullish. What about the Dow Jones DIA ETF, which is up 0.49%? Look at this nice weekly candle here. It was up quite a bit this week. It broke through this little resistance area here. Okay, very bullish. Volume was higher this week than it was the prior week. And look at this. Positive DI is moving up, negative DI is moving down, ADX is moving up. That's what you want. And so that weekly looks good. And the daily chart also still looks very bullish here. What about Russell 2000, which is the ticker symbol IWM? I like this one too. So it broke through this 258.20 level, this prior high. That happened today. So the Russell is looking extremely bullish. I like the Russell right now, up 1.11%. What else are we going to look at? And by the way, there's the weekly chart for you if you really need to see it. That's the chart right there for the weekly. Here's FEZ, Euro Stocks 50. Oh, I like what I'm seeing here this week. It's breaking through a purple line. What is the purple line and why is there a distinction? The purple line represents a monthly level. The W weekly is for usually a blue line, okay? And the daily is usually this type light colored red line. Now, let's look at the monthly for a moment. Here's a monthly chart. We have to go back in time a little bit. Let's go back. All right, we really need to go back really far. Here's all the years. You literally have to go. Let me zoom in back there. Let's go back. Look at this. Whew. 2008. Oh, I hope this isn't an omen. But the fact that we're breaking through those highs from 2007, folks, December 31st, 2007, that's okay. Look at this. That's exactly when things started to go really negative and the market dropped, right? And I'm sure a lot of you guys remember how that played out. Let me measure that for a moment. Let me get rid of those lines for a moment so I can measure it. So from that high right there in 2007, right, December 31st, 2007, down to this low in 2009, that's over like a 1.2 years, right? So that's over basically 15 months. All right. In a 15-month range, it dropped 66.79%. Crazy. And guess what? It's been moving up since. So it looks really good now. As you can see here. Whoops. Let me just go ahead and zoom out of this so you can see it better. There's the drop in 2008. And if we move forward a little bit, you can see how we're back at those levels once again. And we're surpassing them by 36 pennies, which is interesting. But that's also very bullish, and I like what I'm seeing here on the monthly. Look at that ADX. All the same rules apply on any time frame that you choose. If you don't want to be looking at your charts on a day-by-day basis, all right, like I do, and you just want to look at them on a weekly basis. Okay, you can do that. Maybe you don't even want to look at them on a weekly basis. Maybe once a month you want to check on your stocks and see how the health of the stock. You switch it to a monthly chart. I mean, look how many months we've been in a bull market here, multiple months. In fact, it all started happening right here once it broke above the cloud right here. But this was back in 2022, November 30th of 2022, because we did have a pullback. I'm sure you guys remember that too, around June 30th, 2021 to like basically October 31st of 2022, it dropped 38%. Right now, we've been in a nice strong bull rally here for FEZ, the Euro stocks. So that's the monthly. Here's the weekly, and here's the daily chart. It came down, pulled back, found support at the Tenkan-sen, the 9 period, and basically gapped up today. It gapped up, which is nice, and it didn't just gap up like right under the moving, right under that 66 level. What's kind of cool is the fact that it actually gapped up right above that level. It came down slightly. There's the wick that you see right there, and then it continued to move up. I can see all of that, by the way, by switching into a 5-minute chart. So there it is. You can see right here. This was yesterday on Thursday, 4 p.m. This is where we were. That dotted red line gaps up, starts moving sideways for a little bit, drops down, finds some support of the Kijun-sen on the 5-minute, gets back above that 66 level, and now it's off to the races again. So I like FEZ. What else do I like? I like the VIX because the VIX is dropping. And by the way, that's different than the ETFs that you see here that are moving up. We actually do want that to be dropping. The market volatility to be coming out of the market. It's down 4.34% today. That's a good sign. Okay, let's go to the next segment here. These are the stocks that they talked about on the halftime report. So I've got the ones with the blue flag highlighted at the top, and then I'll show you the weak ones as well. But let's start off with BKR, Baker Hughes Company. So yeah, Baker Hughes Company is coming up to a level of resistance. Actually, let me just revise that because that's an old line right there. We do have to revise it to this prior high of 51.12. That's where you're probably going to run into some resistance, okay? And it could create a triple top pattern, right? Because we came close to that level here, we came close to it here, and then if we come for a third time, it could potentially reverse. So I personally would want to wait until it breaks through that 51.12 because we're so close to that resistance level. It needs to close above, in my opinion, before it's something that's interesting to me personally. I'm a breakout trader. That's just my style. That's what I like. You know, I'm not looking to buy stocks that have declined significantly and are still in a downtrend. I'm looking for stocks that are breaking out. And CEF is looking pretty good here. You can see that it pulled back yesterday and then boom, it's up again 2.58%. So Gold and Silver Trust is looking good. CVX looks good. That's the energy sector, oil and gas integrated. Chevron. Okay, here's the daily chart. We do have a bullish cloud. It's not really, it's a weird looking cloud because it was thin here and then it's starting to widen a little bit. And we're also under this level. Let me just show you guys. See this high right here? So the high there was what? 161.85 and 161.86. So we use the highest one, 161.86. Whoops. That's a level of resistance, and it's on a daily chart, so we'll leave that as a light colored line. That's where we're at. It's coming right to it, and then it might find some more resistance up here at around the 165 level. So just keep that in mind with Chevron. Here's the weekly chart for you. Broke up, and then it's spent some of the time this week dropping. Here's a 2-hour on Chevron. It looks a little more bullish. I like that. Okay, so Chevron still gets that blue flag. EEM, which is the Emerging Markets Index Fund, is looking good. Here's the daily chart. It broke above this 56.31 level from October 29th, 2025, that high. That happened on January 5th. It moved up, pulled back a little bit, and now it's moving, continuing. It's moved up. I love this type of setup. It's a beautiful setup right there. Here's the weekly chart. So it's obvious that it's going to stay. It's Friday. It's like 11:55 a.m. It's more than likely, unless some crazy event occurs by the time the market closes, this is most likely going to look good. So look at this around 3:30 p.m. And I'm sure it's going to be still above 56.31. GDX is looking good. That's the gold miners ETF. Here's the weekly chart. And here is the daily chart. Looks fantastic. IJR. I like this one too. It's the small cap 600. It broke above that high right there of 125.84. It's at 126.38 right now. And moving up, look at that directional movement index. Exactly what we're looking for. There's the daily. Here's the weekly chart. Okay. Russell 2000 looking good. Breaking through that 258.20 level. This is from like literally from December 12th. Okay. It's breaking above that today. So Russell 2000 obviously looking strong. You've got Morgan Stanley looking good here in the weekly chart. Here's the daily chart. That looks good too. Here's one of the stocks Jenny brought up, which shockingly is a good looking chart, honestly. NGLOY, Anglo AM PLC ADR. I like it. Look at this. The weekly looks good. Okay. I'm sure technicals had nothing to do with their determination about buying this stock, but it looks good on the weekly and it looks good on the daily. So we'll give it a blue flag. How about XLI? XLI looks good. Industrials. Here it is in the daily chart. Here it is in the weekly. Ooh, I like it. I like it. Up 1.03%. Volume is increasing. Check this out. Look at that volume increasing right there. Beautiful. Look at that directional movement index. Beautiful. That's what you're looking for. All right, let's keep going. XLK. Ooh, look at XLK. It's in the triangle. All right, so it's kind of stuck in this little range here on the weekly. Here's the daily chart. Which way is it going to go, folks? Is technology going to get, pummeled by dropping under that trend line? To be determined. Okay, they keep saying that there's a shift in sectors and everything else, but look, technology, tends to move up generally more than any other sector. Look at XLK here on the monthly chart. We're looking at this on a monthly. These are some old lines staying. I gotta get rid of those. Not even sure how those popped up. But basically, these are some really strange looking trend lines. Anyway, that's the monthly chart. Okay, there's nothing really happening except for the fact that price is coiling up in here. What that means, generally speaking, is there's indecision about where they want the technology sector to go. And we will have an answer on that when price finally breaks through this symmetrical triangle that I drew. Okay, we will have an answer. So just watch and we'll see what happens. But it is interesting how it's just kind of coiling up. And so the sentiment is kind of interesting because if you look here in the daily chart, notice that the negative DI is above the positive DI and the ADX is moving up. It did pull back slightly here and drop because of that move up above the Tenkan-sen, up 1.07%. But yeah, I'd be cautious with XLK until we get through this little situation here. XLV, the healthcare sector, which is, by the way, this is not really a good representation of the healthcare sector. There's literally just about, 60 stocks in here. You can't really get a good, overall perspective about the sector from looking at XLV. I do a much more thorough analysis over the weekend in my members only videos, guys, where I go over all the sectors, okay, and I'm using different ticker symbols that are proprietary to TC2000 that basically look at like hundreds. It incorporates hundreds of stocks in the healthcare, hundreds of stocks in finance, whatever sector it is. I look at the sectors and I look at the industries, the strongest industries within the sectors, okay, and then pick the strongest stocks from those industries. So it's a really top-down approach that has been, it's been very positive for the portfolio, and it's something that you might want to consider. If you want to check that video out, you do have to become a member. Let me show you guys how to do that real quick while we're on the subject. All right, what you would do is basically, see that? This is my channel, Blue Cloud Trading. You hit that join button right there, and this is what's going to happen. By the way, it's free to subscribe. Okay, consider subscribing, hitting that notification bell so you get the videos when I pop them out and post them. But if you click that join button, there's 3 membership levels. You got Blue Cloud Supporter. All right, under this level, you can request a stock or ETF be analyzed once a month. All right, and you're helping to support my channel so that I can keep bringing these videos to you if you like them. Blue Cloud Trader is the next level. You would have to select this, so make sure you click on the right level that you want. It is more expensive, but you do get, this is where you get access to those exclusive member-only strategy videos that I do each weekend. All right, and that's like usually about an hour-long video. I go over my entire portfolio, all the trades that I placed throughout the week. I give more about 25 to 30 new stock ideas for the upcoming week. So there's a lot of data. There's a lot of information I'm sharing. The next level, if you want to go to the next upper level, you become a Blue Cloud Legend, folks, which is also a little bit more expensive. But when you compare it to a lot of the other sites out there, this is still a pretty reasonable amount for what you're getting, because you're getting daily trade, all my daily trade updates. So when I do, once you become a Blue Cloud Legend level, I do, by the way, you also get those the member only videos you get under Blue Cloud Trader. You can request up to 3 stocks or ETFs per month. You get access to some day trading videos that I've recorded, but this is the most important thing, I think, the daily trades update. And you would find that once you become a member, okay, there'll be a new tab that pops up right next to posts. It will look like this. We'll say membership. That's where you click. That's where you'll find those updates. And this is what the member only videos look like. So if you scroll down and you click on the video itself, I think it will, you'll be able to like either become a Blue Cloud Trader from there or Blue Cloud Legend level member. Anyway, let's get into and continue what we were just talking about, which is XLV. And so that's pulling back here. So XLV pulling back from after hitting that monthly level of resistance. Here's the monthly, going back to this month here, September 30th, 2024. All right. So XLV is hitting a little resistance right now. There's a weekly chart. There's a daily, pulled back a little, down 0.11%. So it's really close. We'll see if it can break through soon. Okay, now the rest of these stocks are not, there's something off about them technically that basically make them unappealing to me. BX, for example, Blackstone, which is up today actually, up 1.39%, is inside the cloud. When price is inside the cloud, you don't, according to the Ichimoku rules, you don't want to be adding positions. And so you also don't want to be adding when price is under the cloud, all right? Bearish territory. You want to wait for the breakout, like over here, and you can see how that led to a nice move. You don't want to add positions when it breaks under the cloud, because you can see how that played out right there. That right there, for example, was a drop of approximately 32% in 2 months. This drop here, when it got into the moving averages from that point down to this level here, was another 22% drop. All right. We can go back further, and over here where price broke above the cloud, we can measure that and measure to this high up here. That was a nice 56% move in just 4.2 months. So you can see how that can be very helpful in keeping you on the right side of the trade. And sometimes, by the way, you're also going to get into a situation where price is just going sideways. And that's okay, where price is just crisscrossing. You know what you do? You just wait it out. You know, you draw a little box and you wait for price to get through that area of resistance. And then you consider jumping in, okay? Anyway, let's keep going. CRWV, CoreWeave is another stock they talked about. I don't like this one either. It's under the cloud right now. Yes, it's building a little bit of a consolidation box right there. Nothing to do, folks. EPD, Enterprise Products, no on this one too. Why? Even though it's above the cloud, the faster moving average is still under the slower one. The Chiku span is not above price as it should be. Therefore, you pass. It's as simple as that. INVH, stay out of that one. I think we brought this one up yesterday too. Onto the cloud, no thanks. LDOS, okay, this is looking a little bit more interesting. The price has broken above the cloud. It's staying above the cloud. It's up 2.24%. Looks good, relatively good on the daily, except for the cloud has not turned bullish yet. We don't have single span A above single span B. What about the weekly chart though? Weekly looks good. So the weekly looks great. The daily is almost there. So there you have it. There's a possible situation. Now you're also going to have to contend with some levels of resistance, like this level, the 205.77, based on that candle from November 5th. November 4th, sorry. So, how far are we from that resistance level? Just 2.7% away. Do you want to add a position here when you're this close to resistance? Personally, I wouldn't. I'd wait until it breaks through, right? That's what I'd be waiting for. Anyway, and look, there's even more resistance right there. If you go back in time a little bit further, you can see right there. There's more resistance at that 202 level as well. So yeah, what about Uber? Uber is under the cloud and came up to that 200-day. So that dotted yellow line that you see right there. Whoops. This dotted yellow line here, that's the 200-day moving average. It came up to it, found resistance at the cloud, and dropped. And it's now currently under the Kijinsen. It's down 2.58%. And we've got a bearish cloud still. We have a series of lower highs and lower lows here. You can see that very clearly. We're in a downward trend. It's impossible to determine when that is going to change until, and this is the advantage of this indicator. It helps to give us an idea of when it's more appropriate to jump in. When the sentiment changes, there's more buyers than sellers. Okay, you're going to see it on the chart. Very simple, guys. Let's keep it simple. You don't have to make things complicated when you're buying or selling stocks. Tesla bouncing off the cloud. I like it. I said this yesterday too. I said what's interesting is that we stalled here at the cloud, and a lot of times when price comes to a level of support, which is the cloud itself, it will bounce. It's up 1.93%. Would I be buying Tesla here? No. The Tenkan-sen is still under the Kijinsen. Apple is under the cloud still, holding under that level. No thanks on Apple for now. Meta, inside the cloud. No on that one. Microsoft, under the cloud. Just stuck in this little range. Amazon, okay, this is more interesting. The only problem is that the cloud itself is still bearish. We still have the single span A under single span B, and it was down 0.04% today. And it's kind of far away from the moving averages. It's not an ideal place to be buying, in my opinion. I'd hold off. All right, let's take a look at some of our members' requests. NUE, Newport Corp, Basic Materials. So this is a nice one. This is a steel stock, and you can see that it basically has reached a high of 171.94 back here on January 5th. It's pulled back, found some support at the Kijinsen, bounced off of that area. Right now, it's just stuck, essentially in this little range here. Whoops, wrong thing. It's stuck in this little range. That's all. There's nothing really to do here quite yet. I would not be adding a new position until it gets above that 171.94 personally. And I know you're buying it higher. I recognize that. But you're also buying it at a time when it's basically clearing its way for a new move up, right? It's it's breaking through that resistance where it was finding resistance. And that's key, So yeah, NUE looks good on the daily, and it looks good on the weekly chart. We've got a nice bullish cloud here. It's still in a nice uptrend. I had a position in this back here that I closed out of it on November 28th for an 8.6% profit. Basically, I saw that little reversal candle there, and I just got out, took my money. It continued to move up slightly, then pulled back, then moved up a little bit more, dropped back again. But right now, yeah, if it can break through that 171.94, I think that would be important. And yeah, so keep an eye on that one. HUN, I like this one on the daily chart. It looks really good, obviously, because it's broken through that 200-day, declining 200-day moving average. It's staying above it on the daily. We get a positive, everything positive here with the ADX moving up, okay, up 3.26%. But it doesn't get a blue flag, and the reason is because it's been under the cloud for so long. If you look at the weekly chart, it's still under it. And personally, I like to get confirmation on both time frames. So would I be buying it? No. But to each their own. If you decide that you want to buy this, then I would be managing it 100% based on the daily chart, and maybe even use another lower time frame, maybe a 2-hour, to keep you on the right side of this trade, maybe a 30-minute as well, because you can see here that if you go with these lower time frames, you can actually you can still manage it. The only problem is now you're going from a swing trader to a little bit more active trader where you have to check on it every 30 minutes to every 2 hours, which is not something I personally like to do. So unless it's something like a hedge that I'm doing with an inverse ETF, which is That's, in the event that the market's dropping. But so that's what I personally would not be getting into this this particular stock. Vertex, let's look at that one. Let's start with the weekly chart. On the weekly chart, it broke through the cloud. So that's bullish for the week. However, the cloud is still bearish here. And it looks like the Chico span got above the closing price of the candle. So that's good. The ADX is moving up on the weekly. It's again, the cloud hasn't turned bullish quite yet, but it's almost there. We still have a lower low here, and we haven't taken out this high, right? The 485.71 level. So here's a daily chart. Looks much more bullish. Again, similar scenario. You'd have to just be trading this more based on the daily chart. EW, Edward Life Sciences, is still stuck inside the box here, even though it's up 0.97%, gapped up. Now it's under the Tengen on the daily, and here's the weekly chart. It's still inside the box. All right, guys, thanks for watching. I appreciate all of you. Don't forget to like and subscribe and share this video. Okay, really do appreciate you all. Hope you all have a great weekend. Don't forget, this weekend I'm putting out another members only video. Click that join button if you are interested in becoming a member. All right, and make sure that you select the right box here for whatever it is that you decide that you want to go for. Okay, thanks. Talk to you later.